I hope you all had a good weekend. And we open Monday with another day of volatility. As we discussed last Friday, we should expect that. We should honestly even expect the market to be down a little bit today. And at the close it was, but at the highs of today, it was above the highs of Friday. Now, this could be concerning to some to see all this volatility. Maybe we get another downside from here. I am not concerned. And I think the best thing to do is not be bullish or bearish, to look at things, to look for things that might provide some insights. And I think it's no coincidence that we're getting such volatility right around S&P 4000. That is a good round number. It certainly has a psychological impact. 4,000 on the S&P. And we are just going up and down along that line. If you drew the 4,000 line the last week or so, even the last 2 days, you would see that's kind of where we're trying to figure something out. And we'll see what happens. There's certainly a lot of people who are concerned about the fundamentals. And I would understand that. There are concerns to be had around the fundamentals. Oil prices are high. We're long oil. We are in part benefiting from that because it takes part of our portfolio. But there's no question. I mean, gas prices are hitting records right now. That's going to eat into consumer wallets. And that is not an ideal outcome when it comes to the economy. So much money going to oil, so much spending going to oil. Well, where's the rest of the stuff? Where's the rest of the productivity going to come? And now we've got this pro-con catalyst on our heels. And that is the reopening of China. I say pro-con catalyst because we'll start with the cons. Well, oil's quite expensive, and it's been getting more expensive, and China has been locked down. So now we're getting China back online, and that's a huge oil consumer, the second largest in the world that has been locked down, and we've been seeing prices increase. And it's possible that they send prices up. I say possible because it's also possible that this has some level of common sense to it and the oil market is preparing for that. We're just going to have to see. I don't know what the answer to that is. We're going to have to see, in my opinion. My assumption is it does continue to go higher, and there are pros and cons to that. Well, ceteris paribus, that may be somewhat negative for the market. However, the S&P 500 is down nearly 20%. The Nasdaq's down roughly 30%. We've experienced quite substantial declines. My understanding is the market has priced in significantly a lot of the downside we can and are going to possibly see. And maybe has even overshot that. And I think the market has done a lot of overshooting elsewhere in the broader market. And I feel like I have developing evidence of that by looking into the bond market. There's no question the bond market has re-rated. We've seen a dramatic rise in yields, sharp slope, which translates to what we've seen, the worst sell-off in the bond market that we've seen in decades. So that has reversed. We got up to 3.2% on the 10-year, kissed that level, and now we're stabilizing around less than 3%. So maybe we're going to do something similar in the stock market. We anticipate what's going to happen, like the bond market. The bond market anticipated a more hawkish Fed. It re-rated to incorporate the more hawkish Fed. Everyone knew it was going to happen. The Fed has communicated quite effectively. The most hawkish member of the Fed said everything was being priced into the market. So that the bond market, after Bullard said that, continued to see rates rise, and then all of a sudden started to pull back. So I think people got emotional. They were smart at first. Got emotional as they saw the losses and as the stragglers kind of came in. And then all of a sudden, the selling was a little bit exhausted because it got beyond the fundamentals. and then things calmed down and stabilized. We're seeing volatility now, but I think the volatility we're seeing now is a stage of stabilization. Everyone is aware and fearful of the recession. People who needed to sell and were fearful of selling because of a recession, they probably sold already. They're fearful. They've been fearful. They were fearful, a week ago when the S&P 500 was down 3-4% for like the fourth day in a row. That's when they were fearful. That's when they did their panic sell. Now we're chopping around 4,000. There's still some fear. Some people are certainly hesitant to come in, but there's tremendous cash on the sidelines, and some people are starting to nibble at things. I am quite heavily. I have nibbled. I'm in, I would say. And I certainly think a lot of people are starting to nibble. So the sentiment, I think, has shifted slightly from you got to be on the sidelines to, a recession is coming, but there are opportunities. And I think that is an appropriate sentiment and positive because, in past recessions, the market has anticipated the recession and adjusted. And the market doesn't bottom when the recession is at its bottom. The market bottoms well before the recession is at its bottom. So if we're in the midst of a recession, or if a recession is coming soon or something we have to be afraid of, well, I think it's kind of high time to start buying. That's what history has told us, that the market doesn't bottom when the recession bottoms. At the deepest trench of the recession is typically not the deepest part of the market. So, I see great prices. Even in the most hated sectors. Jumia trading at roughly 2 times last quarter's revenue. I mean, if you listen to the All In podcast, they're talking about how they're excited or more excited about companies trading at 5 times revenue. Previously, they had mentioned companies trading at 100 times revenue. 2 times revenue, I'm pretty okay with. Jumia Technologies, they saw a roughly 50% increase year on year last quarter in revenue. First few days into this quarter, I believe it was April 4th or something, they signed a deal with UPS. That was an interesting deal. I'm excited to see how that's going. Any updates about that on tomorrow morning's earnings call. Let's just, for the sake of this video, assume that company is fundamentally sound and does well in terms of earnings. And I think there's a good chance that's going to be the case. Maybe it didn't happen in Q1, but I think there's a good case for it to happen the rest of the year. And I say that because the IMF actually hiked their expected year GDP forecast for Nigeria, which is Jumia's largest market. The economy is heavily linked to the price of oil. So, that is a fundamentally sound case about a stock that is down 90% from its highs and is trading quite cheaply. So I think it's appropriate to buy, especially if your time horizon isn't next week. If your time horizon is longer than that, I think you can buy, hold, and see a tremendous return over time annualized. I don't know what it's going to do next week. Maybe it doesn't. Maybe it sells off after earnings. Maybe they report good numbers and say, oh, the economy is uncertain, like everyone else is, and people just freak out and sell. That could happen. I don't want to be judged based on what happens tomorrow, but I'm more than happy to be judged on the long-term prospects of that company, and that's why I'm sharing this entire opinion with you. So that's how I'm thinking about things. I'm just hodling my oil, and I'm buying the stuff that I like fundamentally and is tremendously beaten up. And I'm not afraid to take short-term losses on it at all. It's not going to bother me because I feel quite confident about the long-term gains. If I have done my homework on that stock and feel comfortable with it, I say, like I said, the market's down tremendously. Recession fears are no surprise to anyone. They can come and they're not going to shock anyone. And, One last thing. So we called the bottom of the coronavirus pandemic on, I believe it was March 18th. It was either March 18th or 19th. You can go to the early videos on this YouTube channel, either March 18th or 19th. There's a video of me wearing a robe with no shirt on. That's the video. We called the bottom on that video because the stock market was up, but we had tremendous job losses, 500,000 job losses. This was the first wave of job losses of the pandemic, just roughly a week after the lockdowns began. And we called the bottom because the stock market was up when we got that data. The logic was everyone knew job losses were going to be bad. They were fearful of job losses. They got what they were looking for. The bears could have said, "Ooh, look, we got what we're looking for. The economy is going to collapse." But everyone knew that. It was priced into the market. The market was down some 20 or 30% like it is now. And the market was up 1%. Now, the next 2 or 3 days, it kind of puked again. But then it led to one of the most tremendous rallies of all time. So this video has a different thumbnail. We have to exercise patience. We got to be patient. We got to find things at good prices and just hold them. If you've been watching this channel for a long time, if you've been doing what this channel recommends, you've been through a little bit of a tumultuous ride with energy over the last year. The best move was just to keep holding on through. And right now, it seems easy because the stocks go up every day. But before it wasn't. Hopefully, these stocks will go up like energy stocks. We will see. We will see. That's today's video. And until next time, peace out.